Hi, everybody, and welcome back to video number 7 in Chapter 6. One last point on petty cash. We're only going to use the petty cash general ledger account when we establish the fund or lower it or raise it or, for that matter, eliminate it. And otherwise, we're going to replenish it from our checking account. Okay. Um, And conversely, if we decided to add the $100, we're going to increase the fund balance. We're going to take that out of our petty cash or out of our checking account and put it into the petty cash fund to increase it. Okay, physical protection. Minimize the amount of cash we have on hand. Only have on hand the petty cash and current day's receipts. Keep all funds in a vault safe or locked cash drawer, physical control of that. Transmit each day's receipts to the bank as soon as practical. And if you have a lockbox, you don't need to worry about that. It's a lot safer and better to do it that way. Periodically reconcile your balance shown in the general ledger. Bank reconciliations, very important. And so if I'm reconciling a bank account, we did this in our previous courses, but just to review, we schedule any differences between the bank and the company's records of cash. So our reconciling items are going to be deposits in transit and outstanding checks. And that's going to be, those items are going to be recorded as adjustments on the bank side. Bank charges and credits or depositor errors, that's going to be on the book side. But if there's bank makes an error, that would be a third kind of adjustment on the bank side. So the bank side would have deposits in transit, outstanding checks, and any bank errors, which are very uncommon, but do happen. All right. So balance per the bank here. And we're going to add deposits in transit to that. Now, this is per the bank statement. Now, we're going to add the deposits in transit. We're going to have any undeposited receipts, cash on hand. The bank errors that understate the bank balance, we'll put that there, and that's going to be our balance per the bank adjusted. Then we're going to subtract out our outstanding checks, any bank errors that overstate the bank balance, and finally that will be our corrected balance per the bank. Then on the book side, a depositor's side, we're going to add any bank credits, collections, any expenses that we see, any of those kinds of things. And those two items need to match. I won't go through detailed bank reconciliations too much here because hopefully you know this by now. But here, the Nugget Mining Company books show a cash balance at the Denver National Bank of $20,502. The bank statements covers the month of November, shows an ending balance of $22,190. An examination of Nugget's accounting records have identified the following reconciling items. Deposit of $36.80 that was mailed on November 30th is not on the bank statement. That's a deposit in transit. Checks written in November but not charged to the November bank statement. These are outstanding checks. Nugget has not recorded $600,000 of interest collected by the bank. That's going to be a book side correction, adjustment. Bank service charges not recorded. That's going to be a book side adjustment. Any book side adjustment is going to be a journal entry. So the bank returned one of Nugget's customers' check, not sufficient funds. That $220 is going to be a book side adjustment. Nugget discovered that it incorrectly recorded check 7322 written in November for $131. In payment of accounts payable, $311. That's another adjustment on the book side. And then a check for Nugget Oil Company in the amount of $175. The bank now has incorrectly charged Nugget's accompanying statement. That's a bank error, so that's going to be an adjustment to the bank. So how would we record this? Here's the balance per the bank. We're going to add the deposit in transit. We're going to correct for the error. We're going to deduct the outstanding checks, and that will be the balance per the bank. The balance per the book, we'll do a journal entry for collecting this interest from the bank. The company made a mistake, so we need to adjust for that. And then bank service charges and an NSF charge. And so we need to make journal entries for entries 3, 6, 4, and 5 there. And here they are. Record the interest revenue for $600. We record the error recording on the check number 7322 for $180. We'll debit cash, credit accounts payable. We'll record bank service charges here. And finally, we need to put that NSF check back up as an accounts receivable and credit cash for that, because we originally thought it was a good check. We debited cash and credited accounts receivable. Now we just reverse that entry. So after posting those entries, then Nugget's cash account will have the proper balance that agrees to the adjusted bank balance. Okay, here's a review question. A reconciling item in the bank reconciliation that will result in an adjusting entry by the depositor is, and if you answered bank service charges, you'd be right. Alpha, Bravo, and Charlie there are all corrections to the bank side. All right, let's take a look at estimating the allowance based on expected cash flows. Here, the allowance for doubtful accounts and related bad debt expense on a loan or note receivable can be estimated as the difference between the investment in the loan, generally the principal plus the accrued interest or amortized cost, and the expected future cash flows discounted at the loan's historical effective interest rate. So here's an example. At December 31st, the Ogden Bank recorded an investment of a $100,000 loan to Caro King. The loan has a historical effective interest rate of 10%. The principal is due in full at maturity, 3 years. Interest is due annually. The loan officer performs a review of the loan's expected future cash flows and utilizes the present value method for measuring the collectability of the loan. Unfortunately, King is experiencing financial difficulty and thinks he will have a difficult time making full payment. The next slide shows the cash flow schedule prepared by the loan officer. Ogden anticipates that King will pay the full $100,000 principal amount, but only $5,000 in annual interest payments versus the contractual amount of $10,000. Okay, so here's the contractual cash flows. Here's the expected cash flows. And here's the loss on those cash flows, $15,000. So as indicated, the loan is impaired. The expected cash flows of $115,000 are less by $15,000 than the contractual cash flows of $30,000. The amount of impairment to be recorded equals the difference between the recorded investment of $100,000 and the present value of the expected cash flows shown on the next slide. So I'm going to say, here's my $100,000 here, the amount of the recorded investment. I'm going to take the present value of that 100,000 due in 3 years at 10%. So from table 6.2, I'm going to pick up this factor, and that'll be 75,132. And now the interest payable for 3 years, I'm going to use a factor here. I think that's table 6.4. I can't remember. In any event, if I had the book open, I could see it. And away we would go with 12,434. So we're going to expect, in present value terms, to receive 87,566. So we're impaired to the tune of 12,434, not the full 15,000. So Ogden Bank must measure the loss at present value amount, not an undiscounted amount when it records the loss. Okay, now Ogden Bank, the creditor, recognizes an impairment of 12,434 by debiting bad debt expense for the expected loss, and at the same time it reduces the overall value of the receivable by crediting the allowance for doubtful accounts. The journal entry, therefore, is going to be pretty straightforward. Debit bad debts expense, credit the allowance for doubtful accounts for 12,434. Carl King is going to make no entry because he still legally owes $100,000. Okay, so now if I look at the accounting procedures for cash under GAAP and IFRS, here the relevant facts were similar, generally speaking, between GAAP and IFRS for the definitions that we use here for cash equivalents. Unlike GAAP, cash and receivables are reported in the current asset sections of the balance sheet under IFRS. That's a similarity. And then, like GAAP, for trade and other accounts receivable, an allowance for uncollectible accounts should be recorded. The estimation report approach is similar under GAAP. And then, similar to GAAP, the IFRS requires that loans and receivables be accounted for at the amortized cost, adjusted for allowance for doubtful accounts. Differences. Under IFRS, the companies may report cash and receivables as the last items in current assets under IFRS, and under GAAP, we report those in order of liquidity. So IFRS implies that receivables are different. Characteristics should be reported separately. There's no standard that mandates this segregation, whereas GAAP has explicit guidance in that area. And then, like GAAP, IFRS has a different approach to estimating uncollectible accounts on receivables with a significant financing component, i.e., or e.g., notes receivable. So I'll let you read that on your own and study that. And then more differences here. Fair value options, similar under GAAP and IFRS, but not identical. Want to check that in your reading as well. In addition, there's some difference in the financial instruments covered. Under IFRS, the bank overdrafts are generally reported as cash. Under GAAP, such balances are reported as liabilities. And IFRS and GAAP differ in the criteria used to account for the transfer of receivables. So I'll let you read this on your own. And that is going to conclude Chapter 6. And when we return, we'll take a look at Chapter 7. Until that time, bye for now.